David Reyes back here with you. I think you remember that song, Roller Coaster. I think I was skating at the local mall when I was little to that song. Not very well, mind you. But we're talking about a different kind of roller coaster here, and it's the kind that you don't want to be on. That's a stock market roller coaster, and it's great to go up, right? But, that scary part's coming down, and I'm kind of a wimp when it comes to big roller coasters, but I hate losing my stomach, right? That whole feeling where your stomach's in your throat. So I avoid those if I can. My kids like them. But, we don't want to have you losing your wealth, like losing your stomach. And, one of the things that's interesting that I talk a lot about, if you were sitting across from me at my office or you were listening to me in a presentation, is bonds. And one of the biggest issues where people are very, very, I guess, in the dark about is the impact that bonds have had on your portfolio over the last decade or two or longer. And they've had a very positive impact on your portfolio. Since, I think it's 1977, I'm going off memory here. Over the last 40 years, basically. Check this out. The 10-year bond has paid you, compounded, for the last 40 years, 7.5%. Gee, wouldn't you like to have 7.5% on your bond portfolio right now? Not going to happen. The 10-year treasury today is at about 1.5%. So that's the yield you would get on a 10-year bond that you held to maturity. So what's the problem here? Here's the problem. The problem is that the portfolio you have today is not going to get you where you need tomorrow. Because if you have half your portfolio in bonds, and for the last 40 years you've been averaging 7.5%, now you average like 1.5% or less, that portfolio is going to look pretty poor going forward. And most of you that are listening to me have that kind of portfolio. You have this much in diversified stocks, you have this much in bonds. Well, if your bonds are going to give you 1%, 1.5%, and your stocks on a forward base will probably give you 3 to 4 over the next 10 years, as people a lot smarter than me are predicting, you're talking about a 3 or 4% portfolio at the maximum without fees, without taxes. And most of your money is in IRAs. So guess what? It's taxed ordinary income tax. So you'll never even receive that full amount of income, that full amount of return. So that's a problem. And again, it's one of the first things I bring up to prospective clients when I analyze portfolios. If you have a bond-weighted portfolio, there's better ways to do it. Now, there's some more sophisticated ways that I'm not going to talk about right now, but I'm a simple guy. I always like the simple solution. It's usually the best solution, especially all things being equal. If you heard me talk about it, it's called Occam's razor. It's a scientific precept that says when all things are equal, Einstein used this. He's a lot smarter than I am. He said, all things being equal, the simplest solution is always the best solution. So what's the simplest solution to juice up your bond returns to give you more income and more return during retirement? It's really simple. The Wall Street Journal says if you replace your bond portfolio with an annuity that pays you lifetime income, that this acts like a super bond that will give you the highest probability of success in retirement. I've been preaching this for a long time, and it's absolutely true. So if you just did one thing only, and you just took your bond portfolio, so you had 50% stock, 50% bonds, you said, David, what do I do to mitigate risk and give you more income in retirement? Say one thing only. If I had to give you one piece of advice, that would be it. So we sell the bonds, we buy an annuity for you and your spouse. We're going to get 5-6% distribution rates for the rest of our lives, both of your lives. So how would you like to get paid out 5 or 6% for the rest of your life instead of 1% on interest on a bond? And I've seen most of your portfolios, you're not making 1% interest on your bond. You're getting a lot less than that. I mean, a 5-year CD with most banks is paying around 0.25%. Think about that. In the 1990s, 5-year CDs paid around 6%. So if you want to learn ways to reduce the risk of your portfolio, to increase the income, to give yourself a higher probability of success and a better retirement, just give me a call. I'll do a complimentary second opinion with me personally, David Reyes. Give me a call, 1-800-611-1967. That's 1-800-611-1967. Again, or go to reyesplan.com. That's REYES plan.com. So I got to come back to this Mr. Greenspan. I said in a prior segment, I was talking about, it's amazing how Federal Reserve chairmen, how honest they become when they're not in office. when they don't have that chairmanship. And Bernanke's done it, and Greenspan's done it. And it was funny because Greenspan was on CNBC a couple of days ago. Actually, it was Friday. It wasn't funny. It was ironic. And because he would never say things like this when he was Fed chairman. So he said, again, he said that Friday, the UK vote to leave the European Union ushers in a period even worse than the darkest days of October 1987, when the Britons voted 52% that they wanted to leave the Eurozone. And he's called this now the worst period I can recall since being in public service. There's nothing like it, including the crisis of 1987 when the Dow lost 23%. He says these problems are corrosive and will not go away. He also says that he's known for a while the Eurozone is going to be the thorn in the side. It's going to be the problem. And Brexit is not the end of the set of problems, which he always thought were going to start in the Eurozone. And the central bank is limited on what it can do because the problems are fundamental. He says there's only a certain amount of monetary policy that can be done because our problem is fundamentally fiscal, adding that this is also true in the United States. Now, what he's basically saying in English is that, hey, this is a big problem. Pay attention. Don't just think it's going to go away tomorrow. And these problems that are overseas are affecting us today, and the same problems they have, we have. I mean, think about this. China's down 40% in the last year. The DAX, the German stock market, is down over 20% this year. The Japanese stock market, the Nikkei, is down over 20% from its highs. The Italian stock market, I think, is down almost 40%, over 30%. And yet we're down year to date like 1% right now. So do you think we're just immune to this? No, we're not that special. So if you're hearing your broker or an advisor watching the talking heads on television saying this is a great buying opportunity, run the other way. What I would suggest that you do, if you're not one of our clients, but I would suggest that you do number one. Listen up. Is I would reallocate. I would definitely have your portfolio reviewed immediately, and I would reduce the risk of the portfolio. You can do it a couple different ways. You can have more cash. You could buy really short-term bonds if you just want to not make money, but just protect capital, and make sure that that you're really conservative on your stock side as well. So I would look to reallocate. And I wouldn't panic like on Monday. These markets, generally correct, back up, and give you an opportunity to reallocate. Meaning that if you have this big loss, 5, 6, 7%, typically the market will recover about half that usually, 2, 3, 4%. And that's a good time. So basically you're selling high, reallocating high. So that's what I advise you to do if you're dealing with a basic portfolio of stocks and bonds and you don't use the type of strategies that we use at our firm. And again, we use institutional strategies to where we're actually going to buy protection inside the portfolio. We're actually going to purchase insurance, purchase a catastrophic insurance, like a policy you'd buy for your car, your home, your health. Why not for your wealth? So if you want to learn how to protect your portfolio above and beyond diversification as step one, we want belt and suspenders. We want to have multiple levels of protection so we don't lose what we've worked so hard to gain. Give me a call, 1-800-611-1967. That's 1-800-611-1967. Again, go to reyesplan.com. That's REYES plan.com. This is David Reyes, AM 760 KFMB.
You're listening to the Retirement Architect, David Reyes.
Oh, really? A professional man.
We design and build retirements that last a lifetime. The Retirement Architect, David Reyes, will continue next.